Good morning. Welcome to Trading Hour. I'm Sonia Shenoy. With me is Hormus Fatakia. Well, for now, the market is looking very good. The Nifty is climbing by the minute. The Nifty has stood tall at the 22,500 mark. A lot of things actually working in favor for the markets today, whether it's strong global cues, large buying from domestic institutions, the calming of the geopolitical tensions as well. All of that put together has caused a big up move in our market, getting closer to that resistance zone of 22,500. There's no reason to believe, at least as of now, that this up move could get derailed. But let's see. We have a long day up ahead, and the mid-cap space is buzzing with action today. Hormus, hi, morning. Things are looking good.
It's a good morning indeed, and especially just a day before the monthly expiry as well, right? You're not used to seeing this kind of stability in the market in an expiry week when you see it's as fluctuating as the market has been in an expiry week. But as Sonia was highlighting, we are near the resistance zone of 22,500 is the Nifty now. Fourth straight day of gains now for the index. It's a very sharp recovery as well now, almost 700 points from Friday's low, which was 21,777, and from there we have recovered almost 700 points. Let's take a look at some of the top movers that are moving around on the index at least. Cipla is the top gainer on the Nifty this morning, 2.5% higher, and then followed by a slew of metal names, Hindalco, JSW Steel, Tata Steel, all of them trading with gains in excess of 2%. In fact, speaking of metal stocks, the Nifty Metal Index is up 2%, and that is the top sectoral gainer in today's trading session. Among the stocks that are leading the gains within the metals index include the likes of SAIL, Jindal Steel and Power, which is JSPL, and NMDC. Those stocks are doing very well in today's trading session. So metals are the ones that are leading the charge in today's session, and also the real estate stocks that are leading the charge. The realty index is also up 1%, continuing to grow from strength to strength. What is not doing well though is Tata Consumer, and that remains the top loser on the index in a very strong market. Otherwise, the stock is down 5%. You just heard the management a few minutes earlier. So that stock is not doing very well in today's trading session. But what is also not doing well though is ICICI Prudential, and that is under pressure today after its VNB margins declined further in the fourth quarter. Sudarshan is here with the company's fourth quarter highlights. Sudarshan, how are the numbers?
So numbers were mixed, but from opening lows, ICICI stock has made a minor recovery, but still down 3%. So coming to numbers, VNB margin sees a further decline, and it's because of two reasons. First, it saw a dip in non-par business. Non-par means non-participating insurance policy. And the second reason is change in commission structure for the agency channel. But now company expects no further change in commissions, and competitive non-par business might see a change in trajectory as per the company. VNB has fallen 26% year-on-year to rupees 776 crore, and margin was down both sequentially and year-on-year. For Q4, margin was 21.5% versus 32% year-on-year and versus 22.9% sequentially. In the con call, company says it will focus on actual VNB growth going forward, and as per the company, FY24 was a transition year and expects rate to be more normalized in FY25. Coming to brokerage stake, Macquarie has a neutral call with a target price of ₹540 per share. It says company is a last choice in the pecking order, and VNB decline driven by higher than expected decline in margin, and it estimates VNB growth of 11% CAGR over FY24-26. UBS too has a neutral call with a target of ₹640 per share. It says retail protection continue to grow strongly. Jefferies is bullish on the stock. It has a buy rating and it has raised target to ₹680 per share. It says VNB has missed estimates due to fall in margin, and margin fall offsets healthy premium growth. And for FY25, it expects growth to improve from current levels.
All right, thanks a lot for that. Well, 361, on the other hand, is surging in trade post its Q4 numbers. Vamakshi is here to give us more details on that. Vamakshi, over to you.
Well, Sonia, a good set of numbers is what the company reported this time around, and higher than what the street was penciling in, and as a result, the stock is surging in trade today. Let me quickly take you through the numbers. Total AUM was up nearly 3% sequentially to 4.67 lakh odd crores, and this was driven by both the the annual recurring revenue AUM as well as the TBR AUM. The yield on ERR AUM is up marginally to almost 62.8 basis points, while the yield for the TBR AUM has actually risen by by almost 18 basis points sequentially. Revenue resultantly saw an uptick of almost 31%, and the growth was largely being led by the higher transaction and brokerage income, which was up nearly 114% sequentially to 216 crores. Operating expenses have also risen, but they have risen by a smaller margin as compared to the revenues. The cost to income ratio has improved to 52.4% resultantly, and as a result, operating profit is higher by almost 32%, net profit up nearly 24% for the company. Largely, let's also look at what some of the brokerages are saying. Jefferies has given a buy rating, target price has been raised to 930 rupees per share. They have said that the wealth business is in the fast lane, the yields have improved. The AUM scale up by newly added teams should bring down the cost to income ratio by over 400 basis points in their opinion, and this in turn will drive PBT CAGR of almost 20% from FY24 to 27. Citi, on the other hand, has a buy rating on this counter with a target price of 850, and they have highlighted that elevated transactional income has driven the core PBT beat. So largely positive commentary coming in from brokerages. The stock is trading higher today.
Trading higher indeed, but off the highest point of the day is 361 WAM. It was up 13% at one point of time, but still trading with healthy gains of 5%. But moving on then, shares of Cyient DLM are higher in trade today after the company reported a good set of fourth quarter results. The net profit zoomed 80% from last year, while revenue also saw a jump of 30% on an annual basis. Earlier today, we spoke to Srinivas Kulkarni, the CFO of the company, to discuss the numbers, the outlook, and a lot more. Listen into a slice of that conversation.
The margins will improve from where we are currently on a full year basis. Right, we have certain levers for the margins in terms of better absorptions coming from the growth itself. Our SGA is optimized today. I don't think we will further invest in the indirect costs at this point in time. With respect to the ROC, we are currently operating around 11%, and we hope to get to about 15% in the short run and about 25% in a steady state. We are working on several large pipelines and opportunities which are likely to get converted in the coming quarters. Right, and the lumpiness is there. I think some of these orders for 2 years. So till as you consume the orders, you will see the net order book going down, but then you will also get a large order at the end of that tenure. So some of that plays in as well. But from the sales pipeline perspective, we're very confident of growing our order book in the coming quarters. Pipeline is in excess of $1 billion right now, what we are chasing, right, in terms of opportunities. Of course, in EMS, you should also realize that the sales cycles tend to be quite long. We have both the import and export dependency on Israel, and none of that has actually adversely impacted at all. Right, and the other aspect of this is the defense business is growing, so it's also a manifestation of what's going on around the world today, right? So we do see there is no impact basically of that situation. A few conversations there in the range. See, our sweet spot would be between $50 to $100 million, right? I think if something is in that size, it would augur well. The criteria for us to acquire is to sort of enhance capabilities, get some geographic expansion, because some of our clients are outside of India and they prefer proximity, etc. And those are the real drivers for us to sort of make the acquisition.
All right, the other stock to look at is Tata Elxsi. It's under pressure on the back of a weak set of Q4 numbers. Reema is here to tell us what went wrong this time around. Reema, over to you.
Thanks so much for that. So Tata Elxsi has reported a very disappointing quarter. It's a miss on all counts. The company's revenue growth has fallen by 0.6% on a quarter-on-quarter basis. And the growth for the company has been slower. The street was anticipating a bit of a revenue growth. The key reason for that is their media and telecom vertical has been under pressure. Media and communication, that's about 33% of their overall revenues. And in the quarter gone by, it's seen a revenue fall of close to about 4% on a sequential basis. So that's a bit of a concern. Separately, because of that, the margins of the company have come down for the second consecutive quarter, and profits too are down nearly 4.5%. JP Morgan has cut the target price to 5,800. They're seeing this as a sharp all-round miss. They have also cut their revenue estimates by 7 to 8%, margin estimates by 30 to 50 basis points. EPS estimates have been lowered. So as I said, it's an all-round miss. And the company in the conference call yesterday did sound optimistic. They spoke about margins getting back to to their earlier levels of 28%. But, JP Morgan believes they're still a bit skeptical, actually. Morgan Stanley says that, the good commentary may not be enough given the burden of high expectations and steep valuations, so which is why Morgan Stanley is underweight. HDFC Securities says high quality, low growth and high valuation, because this is a stock which is trading at 44 times FY26 PE, so they too have a sell call on the stock. Back to you.
Expensive valuations are weighing on most of these analyst coverages on Tata Elxsi, as in 60% of the analysts that have coverage on the stock have a sell recommendation on it. Pull up a YTD chart as well. And our colleague Yusuf highlighted yesterday that this is the worst performing Tata Group stock so far this year. Now down almost 20% is Tata Elxsi. But the only comfort that investors can take is from the fact that they announced their best ever dividend despite being the worst performing stock. The 70 rupee dividend that they announced was the best in the company's history, comparing to last year's 60 rupees that they had announced. But still, Tata Elxsi 3.5%, almost 4% lower now at 7109. Also pull up Biocon, and that is the stock that is buzzing in today's session, up almost 4% now. And today is not the first day that the stock has been gaining. It's been gaining for the last 3 trading sessions now, and it's up 11% in those last 3 trading sessions. Almost at 300 now is Biocon, well over 4.5% higher at the highest point of the day. So good going there for Biocon. But time for a short break here on Trading Hour. Up next, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins us on the other side. Stay tuned. We'll be right back. Back with us here on Trading Hour. Some more movers in today's session. We were speaking about Biocon just before we went into the break, and that stock is now at the highest point of the day, and it has also broken above its 50-day moving average in today's session. Biocon. So that chart will come up on your screen, which will show you. There you can see it's the yellow line, the blue line that which it has broken above the 50-day moving average now. Well over that now is Biocon, now 4.5% higher at 300. Also pull up ACC. That stock is also doing well as the second day of gains for that stock as well, now up 3% at the highest point of the day, and that is also nearing its 50-day moving average. On the upside is 25.25 now on ACC. That is doing very well. It was up 2% in yesterday's trading session as well. And there you can see Indus Towers as well. Now it's down at the lowest point of the day, down 2%, but it has seen a very stellar run so far this year, almost 80% on a year-to-date basis. So seeing a bit of profit booking from higher levels is Indus Towers. But let's shift focus now to the commodity space. Manisha Gupta is joining in, and today we are focusing on cotton. Manisha, good morning.
Morning, and thank you for that. Well, yes, the cotton prices are in focus because we've seen prices decline by 4% overnight, and in a matter of a week, we've seen prices decline by 14%. That is because the global demand seems to be quite falling. If you look at various important markets like India, China and US, we have seen demand weakening and prices declining in all of these major markets. There also is a report from International Cotton Advisory Committee which says that for the year 2024-25, while they see production increase by 2.5%, they also see consumption increase by 2.9%, and we are going forward on a higher scale here in sense of production. So that is what can weigh onto the markets going forward. The Indian cotton crop also is seen as surplus. The latest revision has been on the higher side, and here as well the prices are quite on the lower side. If you look at the Indian prices also in the matter of last 1 month, we've seen a 10% decline on this. Arrivals have started to come down as well because nobody wants to sell cotton at such lower prices, and demand is not picking up. So either ways, we are looking at pressure continuing into this sector.
Okay, thanks a lot for that. Well, let's do one thing. Let's take a quick break on that note. We have an announcement to share with all of you. We're launching CNBC-TV18's first ever live personal finance webinar, CNBC-TV18 Accelerate Personal Finance Handbook, where I will be joined by 3 well-known experts on Saturday, 11th May, 9 a.m. onwards. We'll be diving into everything you need to know to master your finances and learn how to grow your wealth. Whether it's insurance, tax saving, managing your portfolio, retirement planning, there's lots to learn and lots to do. Whether you're in your 20s, 30s or even 40s, this live webinar is for you. We have limited seats, so don't miss this chance now. Scan the QR code to register or log on to cnbctv18.com, and we will see you on the 11th of May. Well, building on to its gains now, so the Nifty is now over 118 points higher. This is an out-and-out bull market. Not once have we seen any kind of major correction in the market, and every dip has been a buying opportunity so far. But if you're looking at individual stocks, MCX is under pressure after missing analyst estimates for their fourth quarter. Vamakshi is joining in with the details. Vamakshi, over to you.
Well, absolutely, MCX is under pressure after the company missed the street's expectations. But when we look at the company's performance on a sequential basis, the operational profit as well as the company's revenue has seen an improvement. When we talk about the operational performance, it was stronger sequentially, and this was mainly on account of a decline in the expenses, which fell by about 58%. This was largely aided by the drop that we saw of almost 84% sequentially as far as the software expenses are concerned. The software expenses now stand at 23 crores as compared to 146 crores in the previous quarter. Largely apart from that, when we look at the EBITDA, that has seen an improvement. The company had reported a loss of almost 20 crores in last year in the previous quarter, and EBITDA has now increased to almost 102 crores. EBITDA as well as net profit are at multi-quarter highs. The company has in fact reported a net profit after reporting a net loss for the last consecutive quarter. Operational metrics, however, are mixed. Average daily turnover saw an uptick of almost 18% sequentially, but in the option segment, it has seen a dip of almost 16%. Overall, the numbers seem to have improved sequentially, but they are lower than what the street was expecting. Morgan Stanley says that the net profit has missed Morgan Stanley's own estimates as well as the consensus estimates sharply. Operating revenue was much lower than what the street was expecting, and the costs were much higher. So overall, they've gone ahead and given an underweight call for MCX, target price of 2,085 rupees per share. And largely on the back of this, the stock is reeling under pressure as of now.
Under pressure indeed. 6.5% lower is MCX. This is the biggest single day fall that the stock has seen in 10 months. Since June of 2023 is when the stock had declined over 6.5%, 37.55 there on MCX. But if you pull up a 1-year chart, you would realize that the kind of run up that the stock has seen, it just leaves absolutely no margin for error. There you can see 160% higher in the last 12 months is MCX. So seeing a bit of profit booking now after the kind of rally that it has seen. But what is also not doing well in today's session, as we highlighted earlier in the show, is Tata Consumer, and that is on the back of a mixed fourth quarter performance. Manglam is here with the key highlights from the numbers and management commentary. Manglam, over to you.
Well, Hormas, over the last couple of trading sessions, if you look at the way Tata Consumer stock has moved, on Monday it did extremely well. Yesterday it was slightly soft ahead of numbers. Thereafter saw a recovery and ended mildly in the green as well. So there was some optimism building up ahead of numbers. The street was penciling in a good set. Instead, the company reported a mixed set, and as a result of which there was no room for error in Tata Consumer as well, and we are seeing some positions being unwound out there. So as the numbers are concerned, the revenues came in shy of our estimates at 3927 crores. The street was working with a number closer to 4,000 crores, and that would imply a double-digit growth. But what made up for that was the EBITDA, which came in at 630 crores. The street was working with a number of about 600 crores. The net profit was largely below expectations, only on account of this exceptional expense that the company did on account of the scheme of restructuring. What was good was the India revenue up 10%. The India foods business grew about 20%. International margins expanded by about 270 basis points, and growth businesses, which include the likes of Sampann, Soulful and Nourishco, are now 18% of the company's revenue as against 15%, and they've increased the distribution for Capital Foods as well. However, what could have been a lot better is the beverages business, which grew just 3%. The street was working with a number anywhere between 9 to 10%, and tea business as well. The volumes were flat versus 2 to 3% expected growth, and Nourishco, the full year revenue was close to around 825 crores as against expectations of 1,000 crores. So with all of this, we posed these questions to the management, and they said that for the next year, they are gunning for double-digit revenue growth with a firm margin expansion over and above 15.3% that they did last year. And also, they would see 30% growth in their growth businesses, which is Nourishco, Sampann, Soulful, and Capital Foods as well as Organic India. And at the same time, they've also spoken about recovery that they're seeing in Starbucks and a 5% volume growth in their beverages business.
Okay, thanks a lot for that. Well, recovery in Starbucks, that is not surprising at all. Mitesh Thakkar is joining in now for a quick technical check on the market. Mitesh, hi, good morning. I wanted some thoughts on individual stocks. There's so many that are surging right now. 3 stocks are on my list, right? One is Inox Green, which is at a fresh high. Voltas is at a fresh 52-week high as well. And, a couple of other names looking pretty good. Eicher Motors is at a fresh record high, 4,500 or so. Any further upsides in these names and anything else that stands out for you?
Good afternoon, Sonia. I think all the three. I like all the three. So I'll take them one by one. Inox Green, I think, had a weekly closing of about 145 on 12th of April and 143 on 5th of January. So I think that's breaking into fresh weekly swing zone. So I think they should possibly head towards 175, 180 in the short term, possibly 200 in the medium to long term. So very, very positive over here. Voltas is something, which has already been going through a rally. Now it is seeing continuation. So that's another stock, which I would pencil in targets of about 1800 or so there if you take about 6 to 9 months kind of a perspective, or maybe in the short term 1550. But again, very positive stock. We had a big gap up on Voltas a few days back. I think it was on the 8th of April, and then we had some kind of a pullback. I think those lows were around 1270. So anytime you get it close to about 1300, 1320, that will be a fresh entry point, and maintain aggressive targets on the upside. I forgot the third stock.
Eicher Motors.
Yeah. So Eicher is something, which actually was lacking behind till about 2-3 months back, but now has started a trend and rally on the upside. We should see the stock head towards levels of 49.50 to about 5,000. So gives you another 10% kind of an upside from here. Wait for a pullback because the stock in the last 2 weeks has gone up from 4,000 to about 45.60. But wait for a pullback. If you get it around 43.80, will be a fresh entry point with a stop below 4300. And targets of 5,000 can be looked at. And if somebody's holding, then 4,300 becomes your trading stop.
The big news also there in terms of when you speak about Inox, you highlighted Inox Green, Sonia. Inox Wind is going to hold a board meeting tomorrow to consider a bonus issue of shares. And that stock has also rallied almost 460% in the last 12 months. So Inox Wind there not doing very well today, consolidating 0.5% higher, but a bonus issue board meeting as well. But Mitesh, coming back to the index, it's now trading close to its resistance band of around 22,500. Do you see the monthly expiry taking place above 22,500? Does the Nifty have enough legs for that?
Honestly, I wish I knew the answer to it because expiry is tomorrow and expiry days can be volatile. What is good is that the breadth is very positive. So I would say the possibility of a breakouts or move beyond 22,500 are there. Whether it happens tomorrow or maybe next week is something which I'm waiting for. But the way I'll approach the trade is to follow the price action. If we see a breakout beyond 22,500, then go and take a long position with a 100-point stop loss. Otherwise, wait, you'll get that dip if there's a failure to get past those levels. So difficult to say, but my bias is, I would say, on the positive side purely because of the way breadth is performing. And today the Bank Nifty is also picking up. So eventually, I think the breakout should be on the upside rather than on the downside. But will it happen today, tomorrow? Difficult to guess.
What about specific stocks then, Mitesh, this morning?
I have a buy on sale, which is making a fresh swing high. So keep a stop at 155, look for targets of 166. And fertilizer stocks are buzzing. So GNFC is on the buy list. Here I would recommend buying with a stop below 696, which is today's low. And look for targets of 750.
Okay, all right, Mitesh, thanks a lot for that. So that's a lot of stock chat. Let's take a quick break. When we return, Ashi Anand, the CEO and founder of IME Capital, will join in to discuss some market fundamentals. Do stay tuned in for that.
Back with us here on Trading Hour, and let's now get you some market fundamentals. And Ashi Anand, the CEO and founder of IME Capital, is joining us on the show this morning. Ashi, good morning. Thanks a lot for joining in. I remember speaking to you the last time about real estate, and a lot of your microtrends PMS portfolio has a 10% concentration towards the real estate stocks. Now, my question to you was that most of these names, be it Sobha or be it Macrotech or DLF, most of these stocks have seen a surge anywhere between 100 to 200% over the last 12 months. Most of them are also trading above their historical averages when it comes to the valuations as well. Do you still find comfort in these real estate names? Do you think that the upcycle has just begun and there is more to go?
Hi, thank you so much for having me on the show. So I think broadly, yes, we have seen real estate stocks do extremely kind of well. Some kind of a breather post a very strong performance is always kind of possible. But if you're just looking at the longer term kind of outlook, right, you are actually seeing real estate demand coming back after virtually an entire lost decade for the real estate sector. If you look at multiple kind of drivers of real estate demand, it is a direct play on discretionary consumption, urbanization, nuclearization of families, etc. All of these are very, very strong fundamental plays from an Indian market context. According to us, what you are seeing in terms of real estate demand, you are still at early stages of the kind of cycle. What if you just look at results of real estate companies? A company like DLF has had a couple of quarter of $1 billion plus pre-sales, and these numbers were unheard of earlier. According to us, the next big kind of uptick that you're going to see, you're likely to see, is that the price momentum, which has really started in terms of real estate prices. You have seen inventories correct across the board and across cities. Now, as inventories basically reduce, you are going to see a time when real estate prices also start moving up. And this will also kind of help lead to increased investment demand as well as end user demand. Really, the way we kind of look at it is you are seeing real estate at probably the early stages of a multi-year cycle. There's also a very strong shift happening away from unorganized players towards organized players, and there's a very big value migration undergo there. From all of these perspectives, according to us, while stocks have moved up, they are probably factoring in a lot of these positives. Given the very strong longer-term outlook, it is a space that we are still comfortable with, and we believe that they can continue to do well going forward.
What about the entire telecom space? There is this whole narrative about how post the Vodafone FPO, there's a lot of interest now in the telecom sector, especially from investors. Do you see this space broadening out? Is there a case to be built about a three company or rather a 3-player market now sustainably over the next couple of years?
So I would probably argue that the Vodafone FPO is not necessarily a positive from a market or from specific stocks perspective, right? A few years back, you were actually moving towards a narrative of a 2-player market, being Jio and Airtel and possibly Vodafone pretty much withering away. With the FPO, Vodafone does have kind of capital now in order to be able to invest. You're moving from a 2 to 3-player market. There was going to be a very strong push towards kind of pricing improvements with all players adequately funded. I think some of those trends could potentially reduce a bit. We like telecom, but we kind of like telecom the moment you accompany it with certain other services. So like, for example, Reliance is a part of our portfolio. We believe Reliance Jio has a lot of value because Reliance Jio can really upsell various other digital offerings itself. Just pure play telcos is broadly okay because it is important to understand that there is a very large 5G capex cycle underway. This will take up a lot of capital requirements. And at least in the near term, the kind of incremental value add moving from 4G to 5G. Most consumer apps kind of work fairly well on a 4G network. You really need the entire enterprise app ecosystem to really develop before telcos can really start enjoying pricing benefits of the investments they're doing in 5G networks. So the way we look at telcos is we prefer a telco as a larger digital play where having subscribers can be upsold various other forms of services. But just a pure telco on its own, we aren't as optimistic on.
Right. Just before we move ahead, some flashes on your screen, and those are coming from Bloomberg, and that pertain to GAIL. And the flash says that the company is going to shut its Dhabol LNG terminal from the 15th of May ahead of the monsoon rains. It looks like a maintenance shutdown. So that's the flash coming in from Bloomberg. We're yet to officially hear from the company on that front. The stock, though, is up 2%, trading above the mark of 200. We'll keep you updated as more news comes in on this front. But Ashi, a part of your portfolio is also focused on the specialty chemicals, CRAMS and the API section, and it has 3 very specific names, one of which includes Syngene, there is PI Industries and there is Aarti Industries as well. I wanted to specifically ask you about the specialty chemical space, right? Just like pharma, it's a very stock specific sector because every company has its own specialization there, but most of these companies have not had a very good last 6 to 12 months. What's still keeping you hopeful within this space? Do you see better days ahead for the companies? Is the worst over for specialty chemicals going forward?
So let me answer that in 2 specific ways. One at the industry level and then in terms of specific stocks. Because I think the investments we have are specific stock focused and there are specific triggers against each of these stocks. But firstly, at an industry level, I think if you go back a year and a half, there was a lot of optimism around value migration that you were expecting to see from China. What you have seen over the last year is post the COVID reopening of China. a lot of specialty chemical supply from China has actually come back into the markets, and that has led to a certain oversupplies in certain kind of chemicals and pricing pressure as well. Now, I think the worst of that pressure is actually behind us. However, I don't think you're in for a very rapid rebound. You need demand to come back up to be able to take up some of the supply. So I think while the worst of the pressure in terms of specialty chemicals is behind you, there is likely to be an uptick, but it may be gradual. It's not necessarily something which will come in the immediate near term. However, what happens is if you look at stock specific, right? So Aarti Industries, for example, has certain very large projects which are going to come on stream over the coming years, certain new large contracts that they've signed. So that is something that can actually help boost Aarti Industries. Syngene really have the whole Mangalore CRAMS facility, and you're seeing a larger shift away from contract research to contract manufacturing, which really opens up a whole new leg of growth for the company. And PI Industries, according to us, is clearly the best agro input exporter from the country. So we've really approached this from a stock-specific approach. From a longer-term perspective, we see a lot of value in the space. We understand there's been some amount of pressure, but I think that the worst of the pressure is behind us. And when you're looking at specific stocks, there are some very interesting companies which are out there.
All right. I wanted your thoughts also quickly before we, wind down this discussion on HUL. I mean, expected to come out with numbers anytime soon. But the fact of the matter is the stock has been a huge underperformer in the last many weeks and months. Is there anything that the numbers can do to take the stock out of its slumber?
So it's a space that we've been looking at, and I think it's not just HUL, it's the larger FMCG, larger consumption space, which is struggling and which is kind of broadly underperforming. What you have seen, especially over the last year, is consumption demand, which has been very, very strong over the last couple of decades, has actually been quite weak in India over the last year and a half. Rural demand in particular has been really weak, and this has been accompanied by a certain level of weakness in terms of urban consumption as well. Now, it's really this weakness on companies that are really priced in to a decent extent towards perfection, right? When you're trading at 50, 55 kind of Ps, you really don't have too much room for disappointments. When you have this kind of growth weakness and you have a lot of the other parts of the market which are performing, you're really seeing money move away from consumption. You're seeing money move away from banking franchises towards a lot of these new emerging themes. Until consumption doesn't kind of come back, we probably would expect the space to continue to underperform. But from a longer term perspective, HUL is clearly one of the best franchises in India. So it is something which I think from a longer term perspective is fine, but we don't really necessarily see it perform very significantly in the nearer term.
Ashi Anand, pleasure speaking to you as always. Thanks a lot for sparing time this morning and joining us on the show. That was Ashi Anand there of IME Capital. But time for a short break here on Trading Hour. When we return, we throw the spotlight on the telecom sector and we'll be joined by KPMG India's Purushottam KG. Stay tuned, we'll be right back.
Welcome back. Let's talk about the telecom space now, which has been in action for a while. After the Vodafone FPO and with stocks like Bharti Airtel sitting at fresh 52-week highs, the question we're asking is how much is the kind of investment or interest in this space now? Purushottam KG, the partner and head digital solutions and telecommunications industry leader at KPMG India, is here to take some questions. Purushottam, thanks a lot for joining in. I want to understand first from you what this means for the telecom industry, right? On one hand, you've had a good set of numbers coming in from Reliance Jio, Bharti Airtel is thriving, and now the Vodafone Idea has also got a great subscription for its FPO. What does all of this mean for the sector overall?
So firstly, thank you for having me here. And from a sector perspective, you might have seen a quarter-on-quarter growth, an improvement in the sector, not only from a tariff perspective, but also steady subscription growth. 5G auctions have now, the first level of 5G auctions have been rolled out a few years back, and the rollout of the sites and also subscribers have steadily gone up. What it means is confidence on firstly, the rollout of 5G and its utility. The tariffs have actually improved, and that has helped to improve the ARPU for most of the operators. It has also been a factor of some of the 4G subscribers, 2G subscribers moving to 4G and so on and so forth. Steady increase in the number of rollouts of sites, etc. So what it means is that the sector itself is doing extremely well because it is the foundation of the digital economy. Last year, into 2023, we also witnessed the rollout of the new telecom bill, the data privacy bill, and a few other initiatives which are taking the sector in the right direction. The things are very positive. Operational metrics have improved for the telecom operators. There is more focus on operations, rollout of capex in a very efficient manner. You are seeing the results. Although it is far from achieving the real objective because the rollout of networks, as you know, 5G networks is hardly as per the expectations. Approximately 10,000 sites are getting rolled out. We are sitting at around 500,000 odd 5G sites, with the expectation that nearly 50% of the tower sites should be captured by 5G. We are far from that capex rollout expectations as of today. And the announcements that you've seen on the Vodafone FPO, as well as some of the other initiatives that other operators are doing, is to obviously improve the capex rollout and also to focus on how they can service the customers beyond just voice and data, because data, most of the telcos are now moving into a platform player, a techno player, rather than just a plain vanilla pipe.
Purushottam, good morning. Thanks a lot for joining in. You may be having a lot of conversations on ground with a lot of investors and within your own research as well. What is the sentiment with regards to the telecom sector right now? With these latest turn of events over the last month and a half, does it give you enough confidence to say that, okay, the telecom sector is now going to be a 3-player market for sure going into the next 2, 3, 5 years?
Absolutely. There is increased confidence, and it's not a 3 operator sector. It's actually a 4 operator sector. But the way we need to look at telecom is not just the operators, but the whole ecosystem. The OEMs, that have actually supported the actual rollout of the networks. The role that the ecosystem partners have played, cloud service providers have played, data service providers have played, content providers have played in actually uplifting the sector cannot be ignored. So the operators play a very critical role in the whole process because they roll out the infrastructure. And on ground with the partnerships that each of them have actually worked with, some of the enterprise providers, data providers, content providers, there is a fair amount of confidence in it, in the sector itself. How that is going to convert into increase in subscriber numbers is a factor of 2 things. One is how effective is the network in the specific area that the subscriber is, which is gradually improving at this stage. And the second, obviously, is the quality of content that the operators are also able to provide. These are 2 important factors. And the third important thing that you might also want to consider is that, as I mentioned, telcos are no longer a voice or a data provider. They are going beyond the actual the previous services to provide services such as data centers, CDN services, CPaaS services, and so on and so forth. And that is increasing and uplifting the game, working with the entire ecosystem to make it work. So overall, there is a very great positivity on the ground, and that's translating in terms of the numbers as well.
Let's also talk a little bit about tariff hikes, right? There is an expectation that the street has that these telcos will take almost 15 to 20% tariff hikes post the elections. Do you think that could be digested by the markets? I think the last tariff hike was taken way back in 2021.
So all of us are aware that India has the lowest ARPU in the world and the best content when it comes to the quality of content as well as the variety of content that is being provided. In the last 1.5 years, you might have seen a steady increase in tariffs, and that was actually evident, and that was clearly required because you had to get an ROI on the rollout of 5G and some of the content that is being provided. On your question on whether there will be further increase, there is expected to be a further increase in the tariffs. How much that will be is a matter of question, and when it will come in is also something that is not expected. There is a possibility that it could be in the next quarter. On your question on whether it can be absorbed by the subscriber or not, it's if you look at how the customers are actually getting value out of the combined offers and combined offers that the telcos are actually providing, the bundled offers that they are providing, they are actually bringing a lot of ecosystem partners together. And most of the tariff increase that you will see are on those kind of bundles. It is not just on voice and data. The customers are really looking for that value. And if the operators are not able to provide that consolidated bundled value, they will not, it will not get accepted. So I strongly see that wherever you see a increase in tariff, it will be on the basis of a sheer value that the telcos will provide.
What about AGR dues, Purushothaman? Because over the last few years, a lot of these companies have been weighed down by these AGR dues, resulting in piling up of net debt and resulting in the situation that the sector found itself in a few months back. Do you see some bit of relief coming in on that front as well from the government, considering that the market needs to thrive as well with all these companies? Do you see some relief coming in on this AGR front as well?
So if you notice all the efforts that the government has actually taken in the last few years on bringing in new policies, relaxing a lot of the dues of certain operators over a period of time, also relaxing the payment terms for even the spectrum usage charges and things like that. The government has taken those initiatives. There is currently no information that is available if there will be further announcements that will happen. But from the previous announcements and some of the policies that have been rolled out, it is over a period of 20 years. There are relaxations that have been available. Even for the new spectrum auction that is expected in June, those continue. So those policies have already been rolled out, and there is clarity with the operators. Some of the tariff increases that we are seeing is actually helping the operating margins of the telcos to also improve. So in the absence of any further information from the ministry on any further relaxation, I think with the existing clarity, a lot of things are being worked out.
All right. Well, thanks a lot for joining in and explaining the situation to us. Very helpful there. Earlier today, we had a chat with Vineet Sambre, the head of equities at DSP Mutual Fund. Let's listen in to what his view is on the telecom sector. We'll come back.
I think clearly the whole sector actually has seen the revival after this, big shift which is there. I mean, earlier the doubts were cast whether the third player will survive or no. And even today, when we look at the balance sheet of the third player, I mean, things are still up there for them as a challenge in terms of bringing down the overall liability. But now with the fundraise, with the intent, it seems that they will survive. And more importantly, I think for the sector as a whole, the most important matrix which looks like improving going forward is the ARPU level, which has been slow in terms of the historical changes in the past. So I think if that moves up, it brings about a positive change for the sector.
That's all the updates from the telecom space, possibly the sector of the week. But let's get into a short break now. But before that, it's time to shine the spotlight on the backbone of our economy, and that is a celebration of your impact on India's success story. CNBC-TV18 and HSBC India proudly present India's biggest SME awards platform, honoring the small and medium enterprises that drove our nation's growth. Nominations are open now, and we invite you to become an SME champion. Your dreams power India's progress, and it's time to celebrate them. Scan the QR QR code now and be a part of this monumental recognition at the SME Champion Awards. It's not just a platform, but an opportunity for you to step into the limelight. Back with us on Trading Hour, and the Nifty remains at the levels at which we started the show at, remains at 22,450, continuing to face some resistance around the mark of 22,500. 22,476 was the high of the day. So it remains near the day's high, but is struggling to cross those levels. Also pull up Zydus Life, and that is at the lowest point of the day as well, now down 3% after some observations were issued to one of its facilities in Vadodara. Slight recovery from the day's low, but still down 3% at 932 is Zydus Life. But on to some important earnings expected later today. And first up is Hindustan Unilever. What kind of a quarter is likely to be today? Mangalam is joining in with all the expectations. Mangalam, over to you.
Well, the quarter is not likely to be very different from the way the stock price has been, which is absolutely flat in today's trading session. But it's been a big underperformer. From a record high, it's down about 20-25 odd percent, sitting at a multi-year low as well. And we have the stock trading at fair valuations as against its own averages. That's because the street doesn't expect any material pickup in demand this time around. That's the macro setup where rural is still slower than urban, and price cuts will propel volume growth as input costs cool off. So whatever volume growth comes by will be offset by price cuts. So which means that, the street is working with 2 to 3% volume growth in this quarter's results for HUL, and 2% price cut is what the company's gone ahead and given to customers. 150 to 200 basis points improvement in gross margin improvement, but that would be plowed back into higher ad spends. The deal that is, with GSK has expired, so that would have an impact on their EBITDA, and increase in the royalty that they're paying to the parent Unilever PLC will also impact their EBITDA. What does all of this mean for the numbers? Revenues absolutely flat, 0.3% lower to about 14,850 crores. The EBITDA falls a little by about 1%, so that's about 34-30 crores that you're looking at, and the net profit declines by about 5%. You're looking at a number of 2,438 crores. Management commentary this time around will be extremely crucial, also because from the next quarter onwards, they will have reworked some of their segments. So what they plan to do in especially the beauty and wellness segment is something that I'll be keeping an eye out on.
Okay, thanks a lot for that, Mangalam. Awaiting those numbers. Axis Bank is the other one that will be tracking post-market hours today. Abhishek joins in now. Abhishek, what is the street expecting?
Well, Sonia, street is anticipating the slowest NII growth on a YY basis in last 10 quarters. So the key things to watch is analysts are expecting that deposit growth will outpace loan growth. So deposit growth, as per various analysts, are estimated at 6%, while loan growth is expected at 14% YOY and about 4% sequentially. So sequentially, 6% deposit growth and 4% loan growth is what analysts are anticipating. Loan growth will be led by the fact that high-yielding portfolio will continue to grow as seen in recent quarters. Net interest margin can come under pressure. So Morgan Stanley is anticipating a 30 basis point decline in net interest margin and 9 basis point on a sequential basis. Slippages can rise on a sequential basis. Kotak Securities estimates slippages at 4,300 crore, Investec at 4,000 crore, Morgan Stanley at 3,750 crore. All this compares to 3,715 crore in the previous quarter. So you can see rise in slippages. However, asset quality expected to remain stable. Motilal Oswal anticipates gross NPA ratio and net NPA ratio to be flat on a sequential basis. Near-term growth outlook and net interest margin progress will be the key things to monitor what the management does guide in over there. So our polls suggest NII growth of 9% YOY and about 2.2% sequentially. We are working with a PAT of 6,207 crore, which compares to 5,728 crore of loss that they had last year, and about 2.2% gain on a sequential basis to our poll. Back to you.
Abhishek, thanks a lot for sharing these expectations for Axis Bank. Numbers likely to be out post-market hours later today. But pull up United Breweries as well, and that is the stock in focus. Now, that is because Heineken India shared some volume growth data there. They've reported a beer volume growth of lower teens in the January to March quarter, and that is better than the company's guidance. Remember, the company had guided for a mid to high single-digit volume growth guidance, and now that guidance is in the low teens. So better than what the company had guided. So as you can see, the reaction in the stock as well after that data, now 2% higher at the highest point of the day, is United Breweries, 1897, almost touching 1900, now up 10% in the last 1 month. So good positive data coming in there for United Breweries, the stock at the highest point of the day. But as we wrap up on this edition of Trading Hour, here's a programming note for all our viewers. Our Friday special offering, Editors Roundtable, is now coming at a new time. Now catch the biggest market headlines of the week with expert analysis from market veterans and our editors every Friday now at 3:30 p.m. Do not forget to tune in. And that's all we have time on this show. From Sonia, myself, and the team that put this show together, thank you so much for watching. Halftime Report takes the action forward.